You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernal. The Federal Home Loan Bank system received some elevated attention last year when banks rushed to use the FHLB's liquidity resources in the wake of some regional bank failures. The Depression-era system was originally set up to support homeownership in the United States, but has since transformed into an important part of the overall financial system. FHL banks can often operate under the radar, leaving some to wonder whether its structure and forms of accountability are well suited to today's environment. On today's episode, we talk with James Hotchkiss, Senior Director of Strategies and Solutions at the Federal Home Loan Bank of Chicago, about the history of the FHLB system, how it contributes to overall stability in the financial system, and what its future could look like moving forward. Stay tuned. Coming up soon, our interview with James Hotchkiss, Senior Director of Strategies and Solutions at the Federal Home Loan Bank of Chicago. But first, a quick market update. The biggest market mover the last 2 weeks was the March CPI. After many analysts and Fed officials believed high January and February inflation numbers were due to weather disruptions and seasonal adjustment issues, the headline and core indexes in the CPI both increased 0.4%, a meaningful upside surprise to the consensus expectation for 0.3% increases. The report solidifies an acceleration in first quarter inflation from the second half of last year, leaving Fed officials to project even more confidence in exercising caution before starting to cut interest rates. Treasuries sold off 15 to 20 basis points across the curve after the release and set new 2024 highs for yields. Fed funds futures trading is now suggesting expectations for just under 2 rate cuts this year. Yields on 2-year treasuries are finding support at 5%, a round number with sufficient appeal to attract dip buyers. Yields on 10s approached 4.7% a couple times earlier this week, susceptible to cheapening to as high as 4.8% before the next important economic releases in the second half of next week. Along with the PPI data released last week and strong retail sales data at the beginning of this week, the market mood has shifted back to a no-landing scenario where stubborn inflation coexists with strong economic growth and a resilient labor market. Because the Q1 inflation data were such a stark contrast to inflation in the second half of last year, the CPI for April and May will be that much more important in shaping Fed sentiment at its June meeting when they consider whether inflation has re-accelerated or is merely experiencing some speed bumps on the way down. Financial markets are also on edge after Iran fired missiles at Israel last weekend, fearful that a retaliatory attack from Israel could cause a much bigger regional war that further destabilizes the region. For now, crude oil prices in the United States have risen only modestly, and inflation expectations have remained anchored. The lingering geopolitical risks could even out the inflation impacts on bond yields by pushing demand into treasuries from safe haven trades. That's all for the market update this time. Now, our interview with James Hotchkiss. Our guest today is James Hotchkiss, Senior Director of Strategies and Solutions at the Federal Home Loan Bank of Chicago. James, thanks for coming on the podcast.
Thank you for having me.
I think the majority of our listeners are pretty familiar with the structure of the Federal Reserve, the 12 different districts, the different levers for policy, and its general role in financial system regulation. But the Fed is different than the Federal Home Loan Bank System, or FHLB. James, can you walk us through the history of the Federal Home Loan Bank System and how it fits in to the U.S. financial system today?
Yeah, I'd be happy to. Almost 100 years ago, during the Great Depression, it was a time of economic turmoil, bank failures, widespread housing woes, and a lot of mortgage lenders were really struggling with liquidity shortfalls and bank runs. It wasn't a great time, and it was a tough time to keep the housing market afloat. So in 1932, U.S. government stepped in and created the Federal Home Loan Bank System to essentially serve as a central banking system to support mortgage lending by, at that time, thrifts and insurance companies. These regional banks, these Federal Home Loan banks, would over time become the backbone of housing finance, kind of like sturdy beams in a well-built home. So fast forward to today, We have 11 regional home loan banks, each servicing a specific geographic region, kind of like a neighborhood bank for neighborhood banks, a little bit of a twist. They're structured as privately capitalized cooperatives. They're owned by their members, which are locally chartered financial institutions like thrifts, insurance companies, commercial banks, credit unions, community development financial institutions. And as a cooperative, their member institutions buy stock in their respective Federal Home Loan Bank in their district. But there's a catch. They must be investing in residential real estate, either through loans or securities investments, to qualify for membership. Because the FHLB's focus has always been real estate financing. Unlike their cousins, Fannie and Freddie, the FHL banks don't guarantee or insure mortgage loans. So instead, they're playing matchmaker. They're connecting banking institutions to cash so that local community financial institutions can continue to lend and connect consumers with houses.
You mentioned that the government set this up about 100 years ago during the Great Depression. So does that inclusion of the term federal suggest any government affiliation? Is it part of the public sector, or is it really independent on its own, though it relies on a charter provided by the government?
That's a great question. One of the unfortunate things about our history is that we were founded with the word federal in our name, which understandably makes people think we are part of the federal government. In fact, when President Herbert Hoover signed the Federal Home Loan Bank Act in 1932, brought the system into existence, he specifically stated that the creation of the home loan bank system does not involve the government in business. So while we were created by a federal act of Congress, the FHL banks are cooperative institutions that are funded entirely by private capital, by their members. They're not taxpayer funded. So members of the home loan bank system buy stock in their respective home loan bank, which provides the capital for the federal home loan banks to use to operate. With that said, too, then if our members use us, they have to purchase additional stock requirements. So what that allows us to do is create a self-capitalizing balance sheet. So as member borrowing needs grow and usage grows in our products, the capital base of the home loan bank grows as well. And as needs shrink, the capital base declines as well. So we have this self-capitalizing model through our members, and we are self-capitalizing in that regards and privately funded. In no way really are we a public institution.
You mentioned that there are 11 different FHLB regions, and I imagine also that being set up during the Great Depression, they don't really reflect where the economic centers of gravity are in the country today. Are there any differences in how the regional FHL banks operate, and do you think that it could benefit member banks at all if they were geographically placed to better represent today's economy?
Any conversation about relocating federal home loan banks, should keep in mind that these banks have been historically strategically located across the country to serve their regional markets effectively. The FHLBs were designed to support local mortgage lending and community investment. So having that insight and closeness and kind of finger on the pulse of the local communities is still really important. Knowing the needs of the communities in the smaller federal home loan bank districts makes it easier to create products and programs that best support the local needs. While it's always good to explore ways to improve and adapt to changing economic conditions, it's also crucial to recognize the value and stability that the current structure of the home loan bank system provides and allows them to really dive deeply into the community needs of their members.
I've sometimes heard the FHLB system described as the second to last lender of last resort, with, of course, the Fed being the lender of last resort. When do banks decide to access funds from the FHLB instead of the Federal Reserve? Because I think when we look back at the regional bank tensions in March of last year, FHLB got a lot of press coverage, a lot of attention on them because banks were accessing funds from the FHLB system. So why were they going to federal home loan banks instead of the Fed?
I think the important thing to state at the onset is definitely that the Fed is the lender of last resort, right? That's the fundamental part of its purpose. And while the federal home loan banks have a strong track record of providing liquidity to their members in all sorts of economic conditions, we're not a lender that our members resort to. We're lenders that our members are actively and continuously depending on, and they plan for, they incorporate into their financial and liquidity strategies throughout the year and throughout different economic cycles. Most members borrow from their Federal Home Loan Bank on a regular basis, and those that borrow are generally in financially good conditions and see home loan bank advances as an integral part of normal financing. But having said that, we do function as an emergency liquidity provider, right? Our members come to us in times of need for a few reasons. One is because they do use us regularly, right? They're familiar with the borrowing process. They have collateral in place. They know who to call, who to talk to. And we have almost a 100-year track record of being there reliably when access to the markets in times of stress. We have this connection with our members, and they do have that ability to call us up right away and talk to us and get funding. And I think they really do rely on that. And that's part of that comes through. Another reason is, we take a loan collateral for our members to borrow against. And for banks now, you're looking at not just your cash and securities as part of your liquidity book, but the Federal Home Loan Banks can create even more liquidity for institutions by taking those illiquid individual loan assets and then making a liquid line out of it, right? Through the collateral they pledge to us in the form of loans. So I think most of our members come to the Federal Home Loan Bank system because we have time and again demonstrated that we can fund our members' needs for liquidity during times of market distress. That's a positive thing and the positive way that they view us. And I think that's important for the financial system. But because of financial distress, it could be idiosyncratic reasons, right? Members can come to us for sudden liquidity needs. For example, maybe a tornado or a hurricane goes through one or several of their local communities and creates an immediate need for extra funding in that local area in times of rebuild. So we do have members coming in for that and helping support their local communities in that way, not necessarily tied to just banking crises or things like that. The FHLBs can serve as a source of funding when other options are less attractive or when emergency situations arise. We're not typically used as a last resort in the same way as the Fed's discount window, but we are a key part of the financial system that provides reliable liquidity to institutions to support them in times of needs, but also to support housing finance and community investment. I do think one takeaway, though, from last March, during that bit of turmoil in the banking sector, you should, as a depository institution, really be making sure you have multiple lines of liquidity, making sure you have collateral distributed and pledged in a way that's maxing out your potential lines at the Federal Home Loan Bank or the Fed or wherever it may be, and testing those lines on a regular basis.
I think that's interesting that just from an operational standpoint, if you're a mom and pop corner bank, getting the Fed on the phone to kind of get that liquidity that you need might not be as timely as calling up your contact at the FHLB. I'm curious too, I know when banks access the discount window, there are certain conditions in place where it won't become public for a certain amount of time. And the reason is that if it were entirely transparent, then maybe people would interpret correctly or incorrectly that a bank tapping the discount window is a sign of insolvency. And of course, it would become a self-fulfilling prophecy. What sort of transparency is there for banks that access liquidity from the FHLB system?
Federal Home Loan Bank borrowings are reported on bank call reporting on a quarterly basis. It is out there, and that information is available typically the quarter after, they utilize the bank. The other thing I'll say, too, is that there's less of a stigma associated with the Federal Home Loan Bank borrowings. Again, going back to what I said earlier, we're not just there for emergency liquidity use, right? We're there for continually funding members' needs and helping out in the mortgage lending space and community lending, right? So most institutions, most members are borrowing on a regular basis. If you look at bank call report information, nearly or more than half of institutions at any given time will typically have Federal Home Loan Bank borrowings outstanding. So because of that regular usage, they come to us more often. They're using us on a regular basis. We're part of their regular plans. There's not a stigma associated to it.
The way that you've described Federal Home Loan Banks is that they're kind of a bank for banks. And so I'm curious, how do FHLBs manage their own asset liability risk? If the FHLB makes loans to banks that fail, could that mean an FHLB would fail? That exacerbates systemic vulnerabilities, even though it's meant to kind of provide some strength and resiliency?
I can't speculate on the future and don't want to necessarily discuss hypotheticals, but what I will say is the Federal Home Loan Bank system is a robust and resilient network of institutions, and it's designed to support and stabilize the financial system as a whole. So while it's theoretically possible for any financial institution to face difficulties. The structure and the operations of the way the FHL banks are designed is to minimize that risk, right? The FHLBs have been a long history of fulfilling their mission to support housing and finance and community investment, especially in times of financial stress. If you go back to 1932, when we were founded, no FHL bank has experienced a single penny of credit loss on an advance since that time. So we do make sure we're monitoring credit risk among our members and when we're borrowing, but we're set up and structured to minimize as much risk as we can. The other thing I'll point out too is in times of crisis, we have the ability to tap markets and fund ourselves and our members in various different interest rate environments. Taking a look at where we were at during the March banking crisis last year, the FHL banks issued a record $321 billion in debt during a 5-day window during that first week of the crisis there. That's a huge amount without any hiccups or deterioration in funding levels. That really does show the depth of our investor base, as well as the FHL bank's ability to raise some pretty significant funds on short notice. So, there was a handful of failures last year, but more than 3,600 Home Loan Bank members across the country had outstanding advances at the end of March last year. Over half of the banking institutions in the United States. So while the U.S. and banks were facing some challenging environments, the FHLB was able to step in, provide liquidity to ensure these institutions are well situated to weather the storm and be there and play that critical role for stability in the system. The other thing I'll mention too is the federal home loan banks are regulatorily required to hold a pretty sizable contingent liquidity portfolio, enough cash on hand to renew all maturing borrowings for a period of 10 to 30 days, and also assuming that we have no access to financial markets to issue any debt during that time. So we have a pretty sizable book in that regard. That's just what's regulatorily required. Most federal home loan banks maintain additional liquidity beyond those regulatory guidelines to meet obligations in the event of a longer term disruption to the debt markets. We do make sure that we are set up to make sure our members can still utilize us even if we can't access the markets. And then the last thing I want to point out is that our debt is joint and severally liable. So what that means is each home loan bank is responsible for its own debt, but if it can't pay, the other home loan banks are obligated to come in, step in, and fulfill the obligation. But that flows through to other aspects of the system structure as well. The FHL banks operate independently, but they're aware that they're a part of a whole system. So if one home loan bank were to fall into trouble, the other home loan banks would step in to support the members in the communities of that district and keep the liquidity flowing.
You've described a pretty good track record in the 100-year history of FHLBs, and it sounds like a pretty robust system is in place. I still find it interesting that, this initially started as a support system for mortgages, for home ownership. Is there anything, in that process of the last 100 years where the FHLB system, better reflects the financial landscape right now, where we have digital banking and where banking is across state lines and across country lines very commonly? Is there anything about the design that is potentially outdated, or how is the FHLB working to help member banks with the landscape that we have today?
No, that's a great question. In the past few years, we've really focused on helping our members leverage our financial performance for the benefit of their communities through trying to build out and expand on an array of things. First off is making sure that we can tap the markets. We have a good source of knowledge and making sure we're passing on all that knowledge and training to our members as well, right? We're a cooperative. We want to make sure they're benefiting from the expertise we have, right? So helping out the smaller financial institutions in that regards too. But we also want to be seen as a trusted advisor to our members, helping them understand how the markets work, how different things can affect their balance sheets, working with them on providing analytical tools and modeling to help them with their asset liability management needs, making sure they understand how different things affect their balance sheet, making sure they understand how our product works and things like that. And then, as we look towards our centennial of being in existence, we're reflecting on our own role in our district, which covers Illinois and Wisconsin and across the country. The different home loan banks are considering, how we can evolve to better serve the needs of our members and their communities, right? We will continue to change and adapt and listen to our members to make sure we're making products that meet their needs, right? And a lot of the things we're working on now is driven in the affordable homeownership space, right? Affordable rental and homeownership opportunities have been in short supply, and the last few years have really exacerbated that. And economic, development challenges continue to persist in the wake of the pandemic and the ensuing inflation, right? So focusing on underserved communities in our district and understanding where the gaps are between members' products and how we can help fulfill that, help them support that gap has been important to us. So we have part of this is feedback from our members, right? And being close with our members and working with them through various different advisory councils and hearing their needs and hearing where they want to focus and on helping support their communities. And then internally working on new products that help fill those gaps, right? So these could be new grant programs or affordable housing programs or putting more money into down payment assistance for underprivileged or low-income communities and working on ways that we can help our members support their communities through the affordable housing aspect. That's what a lot of the projects that we've been focused on lately.
I think that's a great segue to my next question, which is that the Fed has things like the Beige Book or the Senior Loan Officer Opinion Survey that kind of provide anecdotal or sometimes even data-driven analysis based on their private sector contacts. So what is going on in the economy? What's going on with bank lending? What are they worried about? And I'm sorry, I have to keep bringing up the Fed. I feel like maybe the FHLB is always seeing itself as this little brother that doesn't get as much attention as the Fed, but it's still something that, people are much more familiar, I think, with the Fed's production and kind of output. So does the FHLB system, when they have these contacts, you just described a really good support system for them, are they able to use their contacts to leverage into either publicly available or information that's available just for their contacts about, how the region is doing, how the economy is faring, or where they're seeing difficulties in their lending?
The cooperative structure of the Federal Home Loan Banks, where our member institutions are direct owners, that allows the Federal Home Loan Banks to have a really close relationship and a back and forth with the financial institutions within their district. And that allows the different home loan banks to really have a pulse on the local economy. Through these relationships with the members, sales directors will go out and they'll talk with their members. The Federal Home Loan Banks can really gain a firsthand knowledge of the local housing market, the needs of rural and financially vulnerable communities in their district, and the impact that their products, services, and collateral requirements have there. So there's definitely this feedback back and forth between what we're hearing and seeing from our member institutions, especially the local community banks and credit unions in the district who really have a micro focus on those local communities and understanding the needs associated with them and the trends that are happening there. We do get that knowledge and we work with our members to try and figure out, specific products that will help support those communities, right? Some of these trends are national. Some can be very specific locally, right? Based on different local government rules or regulations or requirements or community trends. Those things can have pretty big impacts on a very specific community. And we can, through our regional nature, really help support and carve out funds or needs based on those areas. Going back to what the Fed does in the Beige Book, that focuses not just on the banking sector, but it also has contacts in manufacturing and services and other areas of the economy that the Federal Home Loan Bank system doesn't necessarily have direct connections with. But there is some overlap, right? The Federal Home Loan Bank's insights are often more specific to housing finance and local community economic conditions. And they're based on the direct experiences of member institutions and the conversation that they're having with their customers, not necessarily direct contacts with, the manufacturers or the small businesses themselves. So while the Beige Book provides a broader, more macro level regional economic conditions across various sectors, I would say the Federal Home Loan Bank kind of feedback and insight are much more micro in nature. Both are crucial for understanding the different aspects of the economy and the needs across both sectors.
It sounds like a lot of what the FHLB does can be under the radar, even for banks that are used to interacting with the Federal Home Loan Bank system. So I want to close just with a kind of open-ended question. What do you think is something that the average bank or even user of the financial system might not know about the FHLB system? Either a service they provide, a kind of interesting thing that you think is underappreciated for what the FHLB system does?
It's really the amount of money we do give back to our local communities. Here at the Federal Home Loan Bank of Chicago, right, we're just one of 11, so I'm not talking about the whole system, just the Home Loan Bank of Chicago. We've given over $500 million in affordable housing grants to 87,000 households since the inception of the grant program back in 1990. In addition to that, we've given another $250 million out in down payment assistance to 50,000 homeowners in our district. That's a lot of money we're working with our members to give back to their communities. I think some institutions, some people don't know about those programs. And, we have a lot of different programs out there to help support affordable housing. And we allocate resources not just to housing, but also what we call our community first programs to address. And this goes back to the specific community needs that we talked about earlier in our specific districts, right? So, we offer below market rate lending programs to our members to help support affordable housing. We did about 2 billion of those advances in 2022 alone. Some of those loans and advances are discounted. Some are actually zero rate that are for lending to support small business development in low income areas. So it's not necessarily just about housing, right? It's about housing doesn't exist in a vacuum. You need a vibrant community as well to support the housing, right? It goes together. And we want to focus on not just supporting housing, but also small business development and just local communities in general. So we do have a lot of that. There's a lot of community support, a lot of grants, discounted programs available to our members. And I think the home loan bank system really does a great job of making a significant amount of money available to help local communities. And I think that's, not really well known. And I think that part of our mission is something that I'm proud to be a part of. And part of the reason I've been here for 15 years. It's part of the culture here, and it's not just something we say we're doing. So Federal Home Loan Bank does want to make an impact and be a leader in housing and not just be there for our members, but for everyone who wants to be a part of the American dream and own a home, right? There's a lot out there that we do that people should be aware of.
James Hotchkiss, thanks for coming on the podcast.
Thank you very much for having me.
That was James Hotchkiss, Senior Director of Strategies and Solutions at the Federal Home Loan Bank of Chicago. A couple things stand out to me from that interview with James. The first is that the FHLB system doesn't receive any public funding, despite having that word federal in its name. I think this is important to keep in mind when some people question whether its role in the financial system is appropriate this day and age. The second thing is how resilient FHLBs have been since their inception nearly a century ago. Despite all the ups and downs of the economy and financial system, the structure of the FHLB system has proven to withstand all of the distresses that have come from downturns so far. The Fed's pre-meeting silent period starts at the end of today with virtually unanimous agreement among market participants that the Fed will leave policy rates unchanged at its May 1st decision. There will be no new summary of economic projections, but with 3 months of worrisome 2024 inflation data now released, we expect the FOMC will shift its guidance somewhat hawkish while still retaining its commitment to data dependence. We also expect that the Fed will announce concrete plans for changes to its balance sheet management. The minutes from the March meeting suggested consensus around slowing the pace of its securities roll-off by half. On the economic data front, the two big releases next week will be the advance release of Q1 GDP and March PCE data. The Atlanta Fed's GDP Now tracker is currently estimating 2.8% annualized growth in the first quarter, more than strong enough for the Fed to keep rates where they are and not worry their policy is causing the economy to slow. The March PCE deflators should come in cooler than the March CPI, a welcome relief for financial markets, but still not enough to quash current inflation worries. The following week, we'll see the first quarter employment cost index, both ISM reports and the April employment report. The ECI could give the Fed some modest confidence that the tight labor market is not a primary source for elevated services inflation. We think the April employment report will reinforce the narrative that the economy is strong, and the Fed will be able to focus more on the price stability part of its dual mandate. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.